So this was our example bond from Thursday. And we had pricing based on face value of $100 million, and we had options for the yield rate. And so we said that this bond was purchased at a premium, this bond was purchased at par, and this bond was purchased at a discount. So it turns out that there's a concrete relationship between the way our price and our face value are related, parallel to the yield rate versus the coupon rate. So remember here that R is our coupon rate and J is our yield rate. And this is our idea of at a premium, at par, and at discount. If our price is bigger than the face value, I'm buying the bond at a premium, then I can think of the premium amount as a loan to the seller to be repaid by the coupon payments as we go through time. So that's the amount of the coupon over the yield. Now these are dynamic. If R is bigger than J, so we're buying at a premium, and the term gets longer, then the price increases. But if R is less than J, we're at a discount, and the term gets bigger, then the price decreases. Because the longer my discount, more that discount is worth. The more the premium is worth, the longer the term. The other way to think of this is that when you buy a bond at a premium, you're declaring a capital loss in the future. I paid $162 million for a return of $100 million in 20 years, because that was the term of the bond we were looking at previously. And if I buy it at a premium, paying 162 now to get 100 later. Now I'll get some more payments along the way, but overall that's capital loss. The fact that that capital loss happens when the bond is redeemed allows me a tax dividend. I lose money in that year, 20 years from now, that lowers my taxes. So I can say I'm already planning to lower my taxes in 20 years by buying at a premium. Now, the other way around, if I buy at a discount, then I get a capital gain at the end of 20 years. And that has tax influences as well. I made money over the course of those 20 years. I got to pay capital gains tax on that. So there are ways to play bond pricing for tax purposes. Questions? So the assumption here is that the redemption amount is the face value of the bond. That's not always the case. Sometimes the face value and the redemption amount are different. We call our redemption amount C. If that's different than the face value, then I can adjust the formula we were using to account for that. I can also think about adjusting the coupon rate. Let's take the ratio of the coupon payment to the face value. No, that would have been R. We'll take the ratio of the coupon payment, FR, to the redemption value. And then, or another way to put this is to say that CG equals FR. So I'm thinking of my payments as a fraction of the redemption value rather than as a fraction of the face value. And again, I'll use the same phrasing. If C is the same as F, we'll redeem at par. And if C is bigger than F, I redeem at a premium. And if it's smaller, we redeem at a discount. Page 209 in the text, there's a discussion, page 209. 30-year bonds went away in 2001. They stopped doing them. And we used to use the 30-year bond as the standard idea of how to predict into the future. And in 2001, they decided, no, we're not doing 30-year bonds anymore. I think this was related to September 11th, but I can't be 100% sure. I wasn't following monetary policy as closely then as I do now. The announcement resulted in a surge in demand. Yield rates fell on 30-year bonds by about a third of a point. A third of a percent. That's a huge change in a day. But the reasons said they were expensive. 30-year bonds were 5.25, 10 years were below a full percentage down. And the government was running a large surplus. Government surplus, we don't need to borrow money as much. 2001, the way we run the government changes. September 11th happens and all sorts of crap goes down. And we start spending a lot of money. In 2006, they reintroduced the 30-year bond. So 5 years go by. They said, no, we do need to do this. And in order to do that, they create a $14 billion issuance. I was just talking about a $100 million loan. The government said, no. We want to borrow 14 billion. People buy some of this. But they guaranteed rates at 30 years. So there's a lot of bond money floating around out there being spent by human beings. Questions? The purchasing examples we did, we bought on a coupon date or exactly one coupon period before a coupon date. What happens if I buy between dates? But when I buy between dates, I need to adjust the price by the fraction of the period between the time I'm buying and the next actual coupon date. So let's think of one period as a unit of time. Normally, this is 6 months. It could be a year, but normally this is 6 months. If I think of a period as one unit, then I can think of the fraction a number between 0 and 1 of the period as I've gone through. So if the coupon date was January 1st, today's October 14th. If it was January 1st, then it would also be July 1st, right? So I can think of the period from July 1, 2025 to the end of the year as the period, and I'm partway through it. How far through am I? That's our t-value. And then I'm going to take my payment idea, my present value, and I'm going to adjust it for this fraction. Now, this is the present value of all the coupons and the redemption amount. And what we've been doing to this point would be calculating from January 1st. That would be the next coupon period, right? So I would say, oh, I'm going to get issued a coupon on January 1st. My brain says, I'm going to get issued a coupon on January 1st. Using my present value formulas means doing that as if it was July 1st. It's not July 1st, it's October 14th. I need to adjust for that. So let's think about this. So really what I have is a timeline, and I can think of the present value, a coupon date that just passed, where we are today, and the coupon, the present value as of the next coupon. Now I already know how to get this value. I already know how to get this value. So I can get either of those because those are on a coupon date. What is the value here? Well, you just got paid, let's use January 2. You just got paid the coupon, right? So if I just got paid the coupon, then there's a redemption value in the future that I'll need to bring back to today. The redemption value brought back to today. And all of the coupons, each coupon is the face value times the rate. And that's an annuity for however many are left times the yield value. That's everything after the coupon. I also need the coupon. There was also a coupon on this time plus FR on date T equals 1. Because we said you just got issued a coupon, right? That's a coupon date. You get issued a coupon there. So this is everything in front of here. N more periods. And the coupon you got on that date. So that's the value right here. It's this amount together. I want the value here. How do I get that value? This is a very straightforward calculation. You know how to do this one. If I know the value here, and I know the rate over this time, how do I get the value here? By the yield, right? So I'm going to use VJ. And I'm going to bring back by this amount. So PT is this amount, P1 plus FR, brought back by the amount of time here. But that amount of time is a fraction of a period. It's no longer an integer. So this becomes the question. Now, remember, V is 1 over 1 plus J. So I could think of it like that. This is the purchase price at time t. So now we come to what I think is one of the strangest combinations of make the math easier versus do what's real in the world. What's t? This depends on who's selling you the bond. The federal government counts days. They're going to call this the actual method. Yes, I'm going to use the word twice, I promise. How? Well, T is the number of days since the last coupon period divided by the number of days in the coupon period. Notice the top is an actual count of days, and the bottom is an actual count of days. Actual method. The problem in this, you need the calendar in front of you because things like leap years and the different number of days in the months matter. So let's use our example. The coupon dates are January 1st and July 1st. Today is October 14th. How many days from July 1st to today? Okay. Do the rhyme with me. 30 days hath September, April. Okay, all of that stuff, right? How many days in July? Okay. So it's July for 31, August, 30 days has September, April, June, and November. Oh, no, there's a 31 in August. September, though, only has 30. And then I get through all October, but I've only gotten through 14 days in October so far. So that's 62, 92, 106. Finish it out. The period goes from July to January next year. So that's 31 in July, 31 in August, 30 in September. There's a 31 in October because of Halloween. 30 days in September, April, June, and November. And December has 31. 4 31s and 2 30s is 184. So T is 106 out of 184. I have no idea what this number is, but there's my T value. This is using the calendar, real days. But I have to remember exactly how many days in every month, and I'm going to F that up at least once. Much less I have to account for leap years, and when leap years do happen and when they don't. So this is a fun one. There's a leap year every 4 years, right? Except for years that end in a zero. But except years that end in a double zero. Except years that end in 500s. Yeah. This is dumb. The calendar is really weird. So the business world said, F this. The business world, corporate bonds, and most municipal bonds outside the federal government use the 3360 rule. Now, the 3360 rule makes your life easier. Every month is 30 days, even the ones that aren't. A year is 360 days, period. The only time you need to count days is in the month you are currently in. By the way, that means that a coupon period is exactly 180 days. Because that's a 6-month period. I don't care whether it's January to July or July to December, it doesn't matter. Because if you think about it, in the real world, the second half of the year is longer than the first half of the year. We just did it up there from July to December 31st is 184 days. That means from January to June 30th is 181 days. There's 3 days more in the second half of the year than there is in the first half of the year, but nobody gives a damn down here. In this method, July, August, September, October is 30, 30, 30, and 14. I don't care that the months aren't 30 days. It's close enough. So this is 104 days out of 180. All right. Please notice we got two different fractions, 106 out of 184 and 104 out of 180. Give me some decimals here because I don't know what these numbers are. They're going to be different, not hugely different, but they will be different. They're not all that different, are they? 5761 versus 5777. They're really very close. But this rounded version makes the computation a little easier. So now I have to adjust my price by this value. An example. We'll use the same bonds we were using in this example, the $100 million 20-year bond. And I want the price on August 1st, 2020. Now, if I go back and look at this example for our 100 million bond, the coupon dates were June 18 and December 18. So let me write that down. And it was issued in 2010. Okay. Let's pick a yield. We had the bond at par, we had the bond at a discount, we had the bond at a premium. Screw it, we'll do all three. So we had three choices of yield. And our coupon rate was 10%. So that means that J is half this. And R is half this. Okay. With this in mind, I need to go two different ways. I need to go from June 18th to August 1st. That would be my coupon date was June 18th. So from June 18 to August 1st. So I'm going to call with the actual, I need numbers of days. So there are 30 days in June, right? But I only had 12 of them here because I started on the 18th. July has 31 days. And then in August, I have 1 day. That's 44 days. To get to December 18th, which would be the end of my coupon period, I'm going to have, again, 12 days in June. All right, 31 in July, 31 in August, 30 in September, 31 in October, 30 in November, and December, the payment is on the 18th. There we go. How many days? There's 30, right? 18 and 12. Two more 30s is 90, and 93 is 183 days. So using the actual method, I use T equals 44 over 183. Okay. I need the prices we paid on Thursday. Here we go. This was our price on Thursday. Wait a minute, that price was for the whole bond. I'm only doing part of the bond, right? Okay, hang on a second. Because I'm looking at the purchase price in 2020. So I've got to get this bond brought forward to 2020. Price on six 2020. That's the coupon period, right? After the coupon is paid. That's our P0. That's where my little picture. That's this date right here. So that's going to be $100,000. I'm sorry, $100 million. That's our face value. I wrote it like this: 1 plus R minus J A N J. But N now, since I'm doing it on 2020, it was a 20-year bond. It's now a 10-year bond. So that's 20 payments instead of 40 payments. Okay. This is based on our J's and our R's. If J is 2.5%, we get P0 equals 100 million times 1 plus R minus J, 0.05 minus 0.025. Those go in parentheses. Times A20J. So that's 1 minus 1.025 raised to the negative 20th divided by 0.025. Multiply that by 8 zeros. One three eight nine 72905.7. Now that would have been the payment on June 18th. But I'm not on June 18th, I'm on August 1st. Okay. Adam, you were the one who told me that if I was here, I brought it back. So if I'm here, what do I do? By multiplying by not V, but 1 plus J. So here I get P0, 1 plus J to the T. And I can bring this payment forward. So I'll take this number and multiply by 1.025 to the 44 over 183. And that'll be the price brought forward. So I take this number and I multiply by 1.025 raised to the 44 div 183. And now my value is more, 139,800,445. So I want to buy this bond further into the future. I got to pay almost $1 million more because I wasn't at the coupon date. I was forward in time. Or I could think of figuring out this one and moving backwards, but that would have used 19, not 20, for my number of payments. This price that we computed, that's typically referred to as the quote price, the market price, the clean price. This price is our actual price. So this is the market price and the purchase price. What we're really doing when we compare the two is we're subtracting off the fractional coupon bit, saying, oh, yeah, this is what you really would pay. Now, what happens if I change this? Change the method. What if I go to the 3360? Well, the only thing that's going to change throughout this entire calculation is T. I get a new T. So again, I'm going to ask, from 6/18 to 8/1, how many days? Because this time I have 10 days, 12 days in June, but July only has 30. And my period is Period's the same every time. What's the denominator of that fraction? A year is that long, but our period is half a year. Because you were looking at me because I couldn't hear you start the 180. That's why I went, wait, a year is only 360, so it's half a year. Okay, so now P0 is the same. 138,972,905.7. But my price at date T is P0 1.025 to 43 over 180. It's not a huge difference. Here's our number for the actual price. And I'm going to multiply that by 1.025 raised to the 43 to the 180. The difference is about $5,000. It's not a huge difference, but it is a difference of import. Was 800,000, now it's 795,000. Difference of about $5,000. Now that's on $100 million, right? So 5,000 out of 100 million is, fractions of a percentage. I have a note here in my notes that said, this needs to be recalculated every day. If you are in the bond market trading on a daily basis, this value changes every single day that goes by. My computer better be chugging through this every morning. All right, what's the new purchase price on this? Usually purchases per 100 or per 1,000 or per. This is going to be a fraction of this number, but it's going to change every single day that we go by. This is harsh, in my opinion. And this is what's going to keep the accountants in business, because there's a lot of recalculation every day. Sometimes, rather than calculating the exact current value of the purchase price and the yield rate, because yield rates fluctuate over time, right? Sometimes it's easier just to use the beginning yield rate. What was the yield rate when the bond was issued? Let's forecast this all the way through. Let's look at assuming the yield stays constant. Let's see what would happen. That's usually referred to as the book value of a bond. My book value calculation, here it is. So here's the idea. There are two different prices going on here. This price, the purchase price, is the one that accounts for the fractional premium as we go through. Notice that the market price is a smooth straight line. Well, almost a straight line. So if the bond is bought at a premium, that's why the market price is going down, because you've loaned money to the seller, then I could look at what the accrual of the premiums, the coupons that I get in the middle. So this right here, this price, that's my book value. It takes the coupon you get and says that's going to earn money in the middle here. It's not like that money disappears. Remember, we talked about you take money out of one account, you reinvest it in another. I get a coupon payment. What do I do with it? Poof, it's gone. I spent it all. If I've got $100 million bond, that coupon payment is $2.5 million. That doesn't just disappear. So I use that. Some of it gets reinvested, that accrues value. So the upper curve here is the book value, the purchase price value that we're going to compute here. By the way, this is a bond bought at a premium. That's why the market price is going down. If this bond was bought at a discount, it should be going up. And that means these sawtooths would be changing in their direction slightly. If the bond was bought on par, then the market price is horizontal. We'll talk more about book value in a little bit, but the idea is that when we change the rate over time, our value changes with it. It makes our computations a little more complex. Not a lot. Again, I'm going to bring back these ideas as we go along. So how do I get the yield rate? In a sense, the yield rate is almost never known up front. It's almost always solved after the fact. What the frick? Why would I put money in if I don't know how much I'm going to earn? Well, let's talk about actually buying and selling bonds. There's a seller and a buyer, right? And the seller says, I want this much. We'll call that the ask. I'm asking for this much for the bond. The buyer offers a price. The bid. The difference between these two is called the spread. It is almost always true that the bid is lower than the ask. Almost always. And eventually, the spread gets narrowed. Well, I'll come down a little. Think about buying a car. You go and you haggle a bit, right? You buy a house. They have an offer. You make a counter offer, and they go back and forth. Eventually, you reach a settlement price. We started with F and N, the face value, the term, and a coupon rate and a yield, and then determined the price. But if I know the price from the face value in advance, then I can use the term and the coupon rate to figure out the yield. Again, I'm going to use my same idea that the price is F 1 plus J to the minus N plus F R A N J on a coupon date one period before the next coupon is due. So we were talking about July 1st, January 1st. So this is January 1st, but you've already been paid the coupon. So you're not counting that coupon. Then I can find, given P, F, R, N, if I solve for J, that's my yield rate. It's also called the internal rate of return, IRR. And again, if I buy it off a coupon date, I can adjust using 1 plus J to the T. I'm sorry, use P equals all of the above stuff. 1 plus J to the minus N plus F R A N J, 1 plus J to the T. I have to bring the payment forward. This is a guaranteed ugly ass equation that I'm going to solve technologically rather than by hand. Example. A bond with a face value of 100, we'll deal with small numbers for the moment, 20 years at 8% coupons. 6-month period, standard US bond. What's the yield? Let's find the yield assuming the price is $70.4. Okay, here we go. 70.4 equals 100, 1 plus j to the minus what? What's our n? Oh, hang on. 20 years. How many periods in 20 years? It's a bond. Bonds go every 6 months, so it's 40. Plus 100 times 0.04. Again, an 8% coupon means a 4% per period. Rates are given per year as opposed to per coupon. Times A40J. Let's divide by 100, make our lives easier. 0.704 equals 1 plus j to the negative 40 plus 0.04, 1 minus 1 plus j to the negative 40 over j. That's disgusting. I want to solve this for j? You got to be kidding me. J is a rate, yes? Let's actually put this equation in here. Y equals, I'm going to put in this entire right-hand side. 1 plus x to the negative 40 plus 0.04 parenthesis 1 minus parenthesis 1 plus x to the negative 40, close those parentheses, divide by x. And then we set that equal to 0.704. J is a rate. I know it's not going to be 100%. So it shouldn't ever be bigger than 1. So I'm going to go into my y value, my window, and I'm going to set my x to go from 0 to 1 with marks every 0.1. And I'm only going up to y equals 0.704, so I'll do the same thing for y. This is going to be a very small graph. I only need to know where this x value hits this curve. There's my yield graph in terms of j. 0.704 is up here. Where do they cross? Second, calculate intersection. There's J. .059. Yeah, that's a disgusting looking number. Graph. J equals 0.0595648 However, just like the coupon rate, I have to double this to quote the yield rate because that's every period. And there are 2 periods in a year. X times 2 119,129,647 or 11.913%. Now, remember, I said bonds can be bought and sold. So I bought this bond for 70.4 per $100. And then I decide, I don't know, a while later, I'm going to sell it. So let me give you some dates. This was a 20-year bond. Let's make its issue date. I wrote it down, January 15th, 2010. Issued on 1/15/2010. And I turn around and I sell it on 1/15/2015, buy at 1/12/25 after coupon payment. So when I bought it the first time, I was earning 11.9 a year. That's my yield. The person I sell it to, what do they earn as a yield? Assuming they keep the bond the whole rest of the time. Okay. I sell at 1/15/2015. How many periods are left? Two periods in 2010, 11, 12, 13, and 14, right? So 10 periods have gone by. Out of 40, there are 30 left. So that means that this price has to satisfy the same equation we used there, only with n equals 30 instead of 40. 112.225 equals 100, 1 plus j to the negative 30 plus 100.04 times 0.04. Let me write that part out. 1 minus 1 plus j to the negative 30 over j. And again, I'm not going to solve this by hand. I'm going to divide by 100, 1.12225, 1 plus j to the negative 30, 0.04, 1 minus 1 plus j to the negative 30 over j. And I'm going to solve this exactly the same way we did in the previous one. I'm going to solve it on here. So I go through and I change this equation. And instead of 40s, I now have 30s. And instead of 0.704, I have 1.12225. That value is bigger than 1. I need to go change my window. By the way, when we did this, the yield was like 0.05, right? I don't think it's going to be huge. So let's make this window smaller, and we'll be able to see a little more clearly what's going on. We get a much wider picture, well, a narrower picture stretched out, so I can see a little more of what's happening. This time, notice that as Yield gets, so the yield value gets bigger, my price should get smaller. So there's my connection. Calculate the intersection this time. And this yield is 0.0334. Oh, 3347915. Double that, and I get 6.696%. So the person who bought this from me is going to earn a substantially lower yield than I did. Why? Why would I have known that even before doing this calculation that their yield would be lower than mine? Actually, unfortunately, no, the number of periods didn't make as much of a difference here. What's the face value of this bond? I paid 70. I bought the bond at a discount. They paid 112. They bought the bond at a premium. If you buy the bond at a higher price, you're earning a lower yield. You're loaning me money, paying it back with the coupons. Their yield rate has to be smaller than the coupon rate because they paid a premium. I paid a discount. My yield was higher than the coupon rate. Okay. By the way, I bought something at 70. I sold it at 112. I made a bunch of money, right? What was my actual yield? So I paid 70.4. They bought at 112.225. How many years did I have it? I only had it for 5 years, and that means that only 10 periods went by. So there's the same equation, only this time there's no 100 involved because I made the price what they paid for it, 112,225, as opposed to what I paid for it. Sorry, I made the value 112, and that's what I paid. Okay, the numbers here are messier, so I'm going to change my window, and I'm going to go up to 100 this time. And I'll just put in the numbers instead of the percentages. Oops, wrong one. I want to make the y's go up to 100. So now when I graph this equation, I have to insert the 112.225 in front of the 1 plus j. I have to insert 4 here instead of 0.04 because that's still the coupon. The coupon's based off face value of 100. And then these exponents become 10s instead of 30s. And then my y value is 70.4. Here's my yield curve. J is 0.94, let's call it 0.095. That means that my yield was 19%. Remember, I have to double this number. In the 5 years I owned this investment, I made 19% a year. Not bad, people. Not bad at all. I also, by the way, got coupons for those 5 years, right? I got 5 years worth of coupons. I could have deposited them and earned interest on them as well. And that could add to my behavior here. My coupons. My coupons were for every 6 months for 5 years. Let's say I stuck them in the bank and I found a nice bank. Let's give me a rate of, I don't know, since this was at 8, let me get a rate of 6. Well, now I can think of, well, what did I do with the coupons? I stuck the coupons in the bank. They earned interest for 5 years. That's the total value of my coupons, isn't it? 10 periods at 0.03 per period. Oh, and remember, I then sold the damn thing for 112,225. What's this number? 4, 1.03 to the 10th minus 1 over 0.03. I'm going to keep a lot of decimals here. If I add the 112,225, I end up with 158 for a total. Now think about this for a second. How much did I pay up front? My original purchase price on this bond. And I end up with 158 at the end of 5 years. I could now ask, what's my yield on this? What's my annual yield on this? I could do this like it was regular compound interest. And I could say, oh, what did I actually make over the entire 5-year period? I went from, I have a future value of this and a present value of 70.4, 1 plus R to the 5th, because it was 5 years. Solve that for R. And I find out that I actually averaged a year 17.5%. Okay. More on this next time. But next time is not Thursday because Thursday is the exam. I will give you the ACTEC formula sheets again. You are entitled to another page of formulas of your own. If you've written them up on the same formula sheet, that's fine. If you write a separate one, that's fine as well. I'll need to see it beforehand and initial it. I will see you all on Thursday. Have a wonderful day.
If we put the those back.
That's fine.
Yeah, I keep both of them.